Putting your house in your child's name while you are still alive is one of the biggest financial mistakes you can possibly make. If you are a parent, you have probably thought about how to pass your home down to your kids. And if you have done any research at all or talked to your friends, someone has probably told you to just put your child's name on the deed to the house. It sounds so simple, right? You just sign a piece of paper, file a quitclaim deed, and boom. When you pass away, the house automatically goes to them. No lawyers, no courts, no probate. I see people do this all the time, thinking they are outsmarting the system. But what they are actually doing is setting their kids up for a massive tax bomb and potentially putting their own home at risk of being taken away by creditors, ex-spouses, or lawsuits. Today, I am going to break down exactly why this common hack is a disaster waiting to happen, the hidden rules the IRS uses to drain your family's wealth, and the one simple thing you should do instead to protect your home and your children. Let us start with the biggest reason why adding your kid to your deed is a terrible idea: taxes. Specifically, capital gains taxes. To understand this, we need to talk about a concept called cost basis. In plain English, your cost basis is usually what you paid for the house. Let's say you bought your home 30 years ago for $100,000. Today, because of inflation and the real estate market, that exact same house is worth $500,000. Your cost basis is still $100,000. The $400,000 difference is your profit, or your capital gain. Now, here is the rule the IRS does not go out of its way to warn you about. When you gift property to someone while you are alive, like signing your house over to your son or daughter, you also give them your original cost basis. So, let's say you put your daughter on the deed. You pass away a few years later, and she decides to sell the house for $500,000. Because you gave her the house while you were alive, her tax basis is your old basis, $100,000. The IRS looks at that and says, okay, she just made a $400,000 profit, and they are going to tax her on that. Depending on her income bracket and state taxes, she could easily lose 15 to 20% or more of that gain. That is $60,000 to $80,000 of your family's wealth completely wiped out, handed straight over to the government. All because you thought putting her name on the deed was a quick and easy shortcut. Now, what happens if you do not put her name on the deed? What if you pass the house down to her the right way after you die? This brings us to one of the most powerful wealth-building secrets in the tax code. It is called the step-up in basis. If you pass away and leave the house to your daughter as an inheritance, the IRS steps up the cost basis to the current fair market value on the day you die. Let's go back to our example. You bought it for $100,000. You die when it is worth $500,000. If she inherits it, her new cost basis is $500,000. If she turns around and sells it the very next week for $500,000, her taxable profit is zero. She pays absolutely $0 in capital gains tax. She gets to keep the entire $500,000. By simply not putting her name on the deed while you were alive, you just saved your child tens of thousands of dollars. But taxes are only half the nightmare. Let us talk about the real-world risks of making your child a co-owner of your property. When you put your kid's name on your deed, you are legally giving them an ownership interest in the home you are living in. It is not just a piece of paper for the future. It is a legal reality right now. Their problems suddenly become your problems. What if your child gets into a bad car accident and their insurance doesn't cover the damages? What if they start a business and it goes bankrupt? What if they fall behind on massive credit card debt? Or what if they get married and a few years later they go through a bitter divorce? Because their name is on the deed to your house is now considered their asset. Creditors can place a lien on your property. A bankruptcy court could potentially force the sale of your home to pay off your child's debts. A judge in a divorce court could decide that your child's soon-to-be ex-spouse is entitled to a portion of the equity in your house. You could literally lose the roof over your head because of a mistake your adult child makes, all because you wanted to avoid a little bit of paperwork. And there is one more major risk people forget: Medicaid and nursing home care. If you ever need to go into a nursing home, it is incredibly expensive. Many people rely on Medicaid to help pay for it. But Medicaid has a strict 5-year look-back period. If you apply for Medicaid, they are going to look at every financial transaction you made over the last 5 years. If they see that you gave away a massive asset, like gifting your house to your kid, they will penalize you. They will disqualify you from receiving assistance for a certain period of time, leaving your family scrambling to figure out how to pay thousands of dollars a month out of pocket for your care. So, if putting their name on the deed is a massive trap, and leaving a standard will guarantees your family will have to go through the expensive, public, and time-consuming probate court process, what are you supposed to do? How do you protect your house, avoid probate, keep the government's hands off your money, and make sure your kids get the maximum amount of wealth possible? The answer is a revocable living trust. A trust is simply a legal rule book for your assets. Instead of owning the house in your personal name, you transfer the title of the house into the name of your trust. Here is why this is the ultimate solution. First, because it is revocable, you maintain 100% control. You can sell the house, refinance it, or change who gets it whenever you want. For all practical purposes, nothing changes about your day-to-day life. Second, it completely bypasses probate court. When you pass away, the house does not get tied up in a legal system for months or years. The person you named in your trust simply steps in and transfers the house to your kids, privately and immediately. Third, and most importantly, it solves the tax problem. Because you owned the property through your revocable trust until the day you died, it qualifies for that magical step-up in basis. Your kids inherit the house at its current market value, and they can sell it completely tax-free. And finally, it protects your house from your kids' mistakes while you are alive. Because they do not own the house right now, the trust does. Their creditors, their lawsuits, and their divorces cannot touch your property. Stop taking legal advice from your neighbors, and stop looking for shortcuts that will end up costing your family a fortune. Putting your child's name on your deed is a trap. Setting up a revocable living trust is how the wealthy actually protect their assets. And it is exactly what you should be doing too. If you want to understand more about how trusts work, and the exact steps you need to take to build an ironclad wall around your family's money, make sure you hit that subscribe button. I break down estate planning and wealth protection in plain English, with no lawyer jargon. See you in the next video.